Oh, awesome. Welcome back. We're going to talk about your debt to income ratio today. So, with mortgages, we're figuring out how much of a house you can afford based on your debt to income ratio, meaning what's your income versus your monthly liabilities. Where most people get this wrong is they're thinking it accounts for every bill that they're going to have. What's really more interesting to look at is what's not counted in your debt to income ratio. So again, we're looking at your gross income, so before taxes, or if you're self-employed, what shows up on your bank statements or what you file on taxes. We're taking that income. We can figure out our maximum debt to income ratio, which is going to be 45% to 50% of that income. And then everything else has to fit inside that number. What's not counted inside that number is your childcare expenses, your car insurance, your cell phone bills, your Netflix account, your OnlyFans account, whatever. But all these other bills, your grocery bill, isn't going to get counted. That's why there's a strict limit on, we can do up to 45 or 50% of your gross income. Because we as a lender, we have to make the assumption that you're going to have other bills somewhere. There's going to be other expenses that you're going to have. Here's your pro tip though. One thing that does count that people don't think does, the one that always trips people up, is Afterpay stuff. So Klarna, Afterpay, ShopPay, these like small monthly recurring accounts that don't show up on your credit report will mess you up if we don't get them counted. So your loan officer has to really look for those to make sure that, hey, like we're counting all these extra bills in your debt to income ratio because they're not going to show up on your credit, but they will show up on your bank statements. Here's your pro tip. Watch out for those the Afterpay accounts.